Are your hard-earned savings truly secure? In an era of unprecedented debt and economic uncertainty, many are turning to gold and silver as their financial safe haven. But with all the buzz, are you clear on what's really driving their prices, how much you might actually need for retirement, and when it might be time to consider letting go? Get ready, because today, we'll be cutting through the noise to give you the expert insights you need to navigate the precious metals market. Why are experts predicting dramatic increases for both metals? For gold, it ties directly back to that potential government revaluation. If the US revalues its gold holdings currently valued at about $40 an ounce to say $20,000, $30,000 an ounce, it would transform the value on their balance sheet from around $850 billion to potentially $5 trillion or more. This sudden influx of cash into the Treasury General account could then be used to pay down significant portions of the national debt. Such an action would not only change the game for the government's balance sheet, but would also likely lead to massive inflation. By replacing outstanding debt with cash, $5 trillion of additional cash could circulate, increasing demand and causing prices to rise. This effect, combined with the fact that the government could simply put in a bid at a high price, effectively setting a floor for gold, would quickly drive up its market value. For silver, the narrative is about a long-suppressed asset finally breaking free. For 14 long years, silver has been exactly that, dormant, overlooked, and suppressed. However, the force is finally here. The market is shifting from a rigged casino of paper contracts to physical exchanges, particularly in Asia, where real price discovery is emerging. When industrial and sovereign buyers demand physical silver and can't get it at the artificial paper price, they're willing to pay the premium because they know that's the real price. This means the price will be determined by genuine supply and demand. Once silver takes on this momentum, the move is expected to be violent, vertical, and irreversible. Both metals also stand to benefit from the ongoing fiat currency debasement around the world, as central banks and non-US investors recalibrate their holdings towards precious metals. First, let's look at where we stand. According to our sources, around the time these insights were shared, gold was hovering roughly between $3,300 and $3,400 an ounce, based on calculations of the US's reported reserves. As for silver, it was trading around $36 per ounce. But these aren't just arbitrary numbers. Powerful forces are at play. One of the most astonishing factors currently influencing gold's potential price increase is the United States government's revealed ability to monetize gold. Our sources highlight a Federal Reserve manual, not seemingly meant for public consumption, which explicitly discusses the Treasury issuing gold certificates to the Federal Reserve. This isn't some conspiracy theory. It's described in plain English as a way for the Fed to monetize gold. Why would they do this? It's a very clever way to solve their quote-unquote debt crisis. Figures like Scott Bent and Donald Trump are reportedly very concerned about the debt, seeing it at an unsustainable level. By selling gold certificates to the Fed, the Treasury would receive credits to their Treasury General account (TGA), which they could then use to pay down outstanding debt as it matures, effectively reducing the national debt without issuing new debt. This process is presented as legal as doing quantitative easing. Now, let's pivot to silver, where a dramatic tectonic realignment is underway. For years, gold and silver prices were largely controlled by a cartel of bullion banks and derivatives traders, hell-bent on controlling perception and price through paper contracts. These futures markets were allegedly used not to discover price, but to manufacture volatility, to discourage physical ownership, and to keep faith in fiat systems intact. However, Basel III regulations are quietly changing the rules, forcing banks to back unallocated paper-based gold and silver with actual physical metal, making the rigged system uneconomical. This has led to a mass exodus from the COMEX casino, with open interest in gold futures down by almost 50%. This liquidity is disappearing into the real physical exchanges. On top of that, silver is facing a severe physical supply deficit with over 700 million ounces in just the last 4 years alone, and this gap is widening. Mine supply is not keeping up, and much of silver production is a byproduct of other metals. Meanwhile, industrial demand is exploding, particularly from sectors like solar panels, EV battery technology, including new Samsung batteries set to quadruple lifespan using silver, and next-generation electronics. The industrial world is waking up to the reality that it can't build the future on iOS. This demand, coupled with dwindling supply, puts immense upward pressure on silver's true physical price. Now, for the big question many of you have, how much gold and silver do you need to retire? Let's start with silver. Our sources define what it takes to be a top stacker. To be in the top 20% of silver owners worldwide, you'd need 45 to 60 ounces. For the top 5%, it's 150 to 195 ounces. And to be in the top 1% of silver owners worldwide, you'd need 490 to 640 ounces.